We are perhaps teetering on the brink of World War III with a war with Iran. Inflation has just shown to be ticking up slightly in the latest data sets, and unemployment continues to rise with job losses rolling in month after month. So, what is an investor to do?
Welcome to the Secrets to Abundant Living podcast. Your guide on this journey is Amy Sylvis, ready to unlock the keys to a life of true abundance. We're diving into everything from financial freedom and optimal health to meaningful relationships, geographic freedom, and everything in between. It's about creating a life rich in experiences, purpose, and joy. If you're ready for the secrets to an abundant life, hit that subscribe button now, and let's get started.
Hey everyone, welcome to a solo episode of Secrets to Abundant Living podcast. I am Amy Sylvis, your host and the founder and principal of Sylvis Capital. I'm excited to welcome you to this episode today. I always do a lot of preparation, but I've done quite a bit for this episode because I want to walk through a thought experiment with you all. There's so much going on in the news, and I get questions from investors in our real estate deals about how we're looking at Sylvis Capital at the current economic environment, the political environment, the global stage, and everything that's going on, how we're processing all of that. So, you get I've said this several times, but I'll say it again. This is not investment advice, but instead it is just education around how we're thinking through things here at Sylvis Capital and just giving you education that may or may not be useful to your portfolio here. We're starting to hear the analogy of stagflation, not the analogy, the label of stagflation. Are we going into stagflation here in the United States? And it's very possible that we are. For those who aren't familiar with that term, that is where inflation is higher than normal and where the economy isn't really growing much. And for those who study economics or were around in the 70s and part of the 80s, that decade or so was one of the best examples of stagflation we've had in the United States. So 1971 to 1982. And stop me if you've heard this before. The triggers of the economy, you know, being pretty rough and inflation were high back then was an oil embargo in 1973, significant geopolitical instability, the Cold War, Vietnam, a weak dollar after the U.S. took the dollar off the gold standard, thanks Nixon, rising national debt. Tell me if you've heard that before. And a Fed that was slow and then aggressive on rates. So sounds a little bit familiar, right? I think it's a great template. Hey, history, they say history repeats. Sometimes people say history rhymes. But I think we are all wise to really study what's happened in the past and know that it might not be a complete cut and paste, but really understand what happened, what were the triggers, what are the similarities to now, what are maybe some things that aren't similar to now, and see how that might be able to inform an investment strategy. As a reminder, real GDP growth averaged 3.2% for the decade, which is well below the pace of 4.3% in the 1960s. So quite a bit lower. And the S&P 500 had nominal gains of just 17% for the entire decade. So nominal gains that's when you don't take inflation into account. So something to think about. Most people quote nominal gains instead of reals when you take inflation into account, but think of 17% for the S&P 500, the stock market, over an 11-year period of time. And in real terms, from 1971 to 1982, the S&P 500 lost nearly 50% of its value. So that's inflation adjusted. So similarities. I'm not saying that that's necessarily what is going to happen for us over the next decade, but I do think there are certain things that rhyme. I'm sure you would agree as well. So how does that inform what our investment strategy may be here at Sylvis Capital? I'm not saying this should be yours. Again, it's just what we're thinking through here and might be of interest for you all to do more studying, ask more questions, go down an educational path that might be interesting to you. So, over the period of stagflation in the 70s, what investments did well and what investments didn't do well? Let's talk about that. And then we'll talk about how I, myself, my family, we're positioning our portfolio. And some of it may sound familiar, but some of it I think is likely going to be new to you. Gold and precious metals was trading at $35 an ounce in 1971. And by the time the 1970s ended, with inflation was at 14%, gold was at $850 an ounce. That was a 2,300% gain. That's nominal, by the way. So all of these are nominal. And look, is gold going to be, I'll give my commentary later, but this is a little bit of a different circumstance. I'm not sure gold is going to explode that much in the future. Not investment advice, just my own analysis. The United States is already off the gold standard now. That was a pretty historic change that happened in the 70s there. So that likely, spurred quite a bit of gold's nominal growth there, but also inflation was quite high. So we can't discount that. That was, 14% is, we almost hit that in COVID, but not quite there. So gold did really well. Commodities did quite well. The S&P GSCI index, which measures commodity investment performance, returned 586% between 1970 and 1979. So energy and raw materials were particular standout performers. So in commodities, this doesn't necessarily mean a stock that represents a commodity, right? These are two totally different things. A lot of us are taught that, hey, you just buy a stock that represents something and that's the same as the something that it represents. And I'm not saying you shouldn't buy the stock, but just keep in mind that some of these performance metrics aren't the same as what's actually happening with the asset as opposed to the paper that represents the asset. That's the same with gold and precious metals. Real estate. So we're looking at REITs. So these are real estate investment trusts. These are stocks that represent real estate companies that invest in real estate. They had about 13% nominal annual returns during that period, or 4.5% real returns, meaning after inflation, from 1973 to 82. Certain segments did even better. Farmland rose 14% annually. This is nominal, which was outpacing inflation during the time. So real estate's a little tricky, as I'm sure you can understand, because is it single family? Is it commercial real estate? Is it farmland? Is it medical office? Is it retail? Because these things aren't necessarily publicly traded, they can be privately owned. There's a lot of nuance in the real estate kind of space there. But anyway, REITs are still worth talking about. Some of you may invest in REITs or might be interested in them. So that's worth mentioning. Energy stocks were a real outlier in the stock market, as you can imagine. Oil prices had a massive spike. So they went from $3 a barrel to 40, which I can't imagine them spiking over 1,000% in 2026. But as you can imagine, energy stocks did quite well as a result. Defensive and consumer staples and healthcare did quite well as well. So these are also stocks, right? So they did quite a bit better than the market, and they were able to maintain a good profit margin. And then when we talk about stocks, value stocks versus growth stocks, I'm sure you all understand the difference there. But richly valued growth stocks had lofty price to earning ratios, PE ratios, and those were hit hard as inflation continued to increase in the 70s and interest rates really slammed valuations in the growth stocks. So value stocks tended to do quite a bit better. Will that happen in the future? This is not a copy and paste of the 1970s, of course, but I think it's really interesting to think through the role of inflation, especially given where our national debt is right now. So what did not do well at that time? Bonds and fixed income. So those that are fixed income investors, those that invested in bonds, as you can imagine, they suffered tremendously, right? Because interest rates caused bond prices to plummet. The 10-year treasury yields soared from 6% in 1970 to over 15% by 1981. 1979 alone, long-term government bonds lost 8.6%. So it shouldn't be a surprise to you, but I think it's definitely worth calling out. Again, are we saying that this is going to happen in the future? Nobody knows, but it is interesting to study. Cash, of course, cash feels safe. You're scared. You're thinking, what in the World War III is going on? I don't understand what is coming with AI. these layoffs, the higher unemployment, all of it feels scary. We're not here to gaslight you. Cash feels safe, but goodness gracious, even if inflation is 3 to 4% a year, you're losing quite a bit of value in cash. That doesn't mean you shouldn't have cash. This is not investment advice. I myself have cash on hand, but it is not, say, a main investment staple of my portfolio. I haven't pulled everything out of the stock market and the bond market and real estate, gold and silver, just to kind of sit on a big pile of cash because I know the risks there. That might be a good strategy for you. I don't know your personal situation, but as you can imagine, cash didn't perform well during the 70s. Have you ever thought about having multiple streams of income? Instead of relying on just one stream of income where you're trading your time for money, how would you like to free up more of your time and live a more abundant life? As a listener of the show, you're invited to attend one of our upcoming trainings where I'll give you an inside look into how you can add passive income and get all the other perks of recession-resistant real estate investing without the headaches of being a landlord. I'll also be sharing some hidden mistakes to avoid and the criteria I personally look for when evaluating potential investment opportunities. To reserve your seat for free, go to sylviscapital.com/webinar. Again, that special link to reserve your seat for free is sylviscapital.com/webinar. I look forward to seeing you on the training. And now back to the show. So growth stocks, as I mentioned, they got hit pretty hard, and long duration equities. So as interest rates rose, valuations compressed. So I want to return to the bond kind of issue because, some wealth advisors, let's say that, they think that a classic 60/40 portfolio allocation is the safest and best way to go. And we can dive deep into the 60/40 portfolio allocation. But let's just say 60% stocks, 40% bonds is an old school way that wealth advisors or investment advisors used to allocate folks and their wealth. But as you can imagine, that did not do quite well during the 1970s. And now stocks and bonds are usually positively correlated with each other. So even then, at least for my portfolio, I don't want to be in assets all move together. Everything all moves up or all moves down together. I want personally assets that move at different times to smooth out the performance. So that class 60/40 portfolio didn't do all that well. Doesn't mean it won't in the future, just what happened in the 70s. So I want to return, given that full context, I'd love to talk to you all a bit more about my personal thesis. Again, this isn't to try to get you to do anything. This is not financial advice. I'm sorry I'm saying that constantly, but it's really important to me personally because I don't know your personal financial situation. That's what advisors are for. We're just here to give education. But it's no secret to you all. I have gold and silver. They're not stocks. It's bullion. I have them in vaults that are stored in third-party vaults. I do have stocks. I do have bonds. But I also have real estate. We've acquired real estate. And I've had some people say, oh, is real estate still the place to be? Is this still a great investment for one's portfolio? And the answer, of course, is it depends. I know it's right for mine, and I'm going to tell you how I've thought through this, but it may be the exact opposite of what is right for you. But the type of real estate that we invest in and I will continue to invest in, are apartments, not luxury apartments. I'm not talking about class A, everything is new, top of the market, not that. I'm looking at what are called class B and class C apartments where middle income workers, the teachers, the nurses, the police officers, the retail managers, the manufacturing technicians, those essential community workers who earn roughly 68 to 80% of area median income where they live. And the reason is severalfold. The first is, people are always going to need a place to live. That by itself doesn't mean that real estate's a great investment. But when packaged with understanding that, yes, folks do need a safe, clean housing within their budget near employment centers. And while no asset is recession-proof, workforce housing, and that's kind of what that's characterized by the Class B and Class C, tends to be less susceptible to downturns because demand for an affordable place to live remains relatively consistent. So this isn't the top of the market. This isn't the super fancy schmancy type places. And we do see in the 1970s that these types of investments did do quite well. Does that mean they'll do quite well in the future? I'm not saying that, but through my expertise, my experience, my research, and understanding how the apartment market can work, it looks like a very good bet for my money, for where I'm going to invest my portfolio. So, as we do look at economic instability, as we look at inflation, as we look at perhaps layoffs increasing, folks are still going to need a place to live. And as inflation rises, home ownership can become less and less affordable. And workforce housing, workforce rents can stay put and stay affordable for longer. So we think of, and obviously it's not just when one is buying a house, it's not just, hey, what's the mortgage rate going to be? But it's saving up the down payment. For some people, even coming up with 5% down in some areas might be prohibiting. So that is one aspect. Being able to provide safe, clean, affordable housing to middle income workers. Yeah, we also love to be able to support them, right? We love the impact of this, of being good landlords that care about people, that take care of problems that the residents have, like maintenance requests quickly, making sure a place is safe where folks can, lay their head down at night after a hard day's work, and making sure that we keep the area safe, creating community, creating an area where people feel welcome and that they can form friendships, or even have family members live in neighboring units. All of that matters to us, obviously, above and beyond the just the dollars and cents, as it were. So thinking about how, if inflation does get higher, it might increase demand for workforce housing. The other thing to consider is, with other types of real estate, office and industrial, their leases aren't just 12-month leases like we get in apartments. They can be up to 10 years. And those agreements can allow for rate increases by the tenants. They're typically locked in well in advance. So with apartments, we're able to handle these renewals once a year, and that gives us, as the owners and investors, time to adjust our apartment rates to keep up with costs and market dynamics. Now, obviously, we're not looking to completely fleece our residents, or, put grandma out on the street because she's on a fixed income and can't afford the rent with higher inflation. That's not it at all. But as insurance increases, or property taxes increase, or utilities increase, we like to be able to make sure to have that reflected so we can still make a profit for our apartment buildings and our investors. So the inflation adjustment is a big thing. The other thing to think about is, apartments in the United States, we're around 2 to 3 million housing units short still in the United States. Building has not kept up with population growth. So, and the wild thing is, construction has slowed dramatically across the United States. We are in some markets where construction really ramped up during COVID, and we're just starting to see that taper off. So higher borrowing costs. You remember in 2022, the Fed essentially tripled rates at the fastest pace in over 50 years. So the borrowing costs went up, construction inflation. So less units are coming to the market, which tightens supply and puts upward pressure on rents for existing apartment owners. Again, we want to be fair. We want to be reasonable. We're not out here to just charge everyone as much as we possibly can and you've got no choice. It's not that. But as investors, we are looking for a favorable conditions to invest. So we talked a bit about these drivers here, and those are some of the key, not all of them, but some of the key reasons of, hey, homeownership might become a little less feasible during times of high inflation, like we saw in the 70s. Home prices increased quite a bit in the 70s when inflation hit 12%. Median home prices rose by approximately 16%, that's a lot. Great if you're a homeowner, but if you're looking to buy, it might put you squarely in workforce housing. The fact that there are shorter lease cycles in apartment real estate, so we can keep up with inflation there, as opposed to retail or office where the leases are longer. The fact that there is a shortage of housing and new construction has really fallen off a cliff. And the fact that, real estate did do quite well during the 70s as a whole. There are nuances. Some areas did better than others. But I really hope that this kind of broad overview gives you an understanding of where you might further your education. Perhaps you read a book about precious metals, or you attend some webinars about commodities, or you dive deeper into stocks and bonds and see, what might work for you there and how your portfolio is allocated, or you talk with your wealth advisor to see what that looks like, or maybe you dive more into real estate and see, if you want to own a rental or you want to invest alongside somebody else, or what that might look like. So I thought this is a really interesting way to feel empowered when, I don't know about you, but the news just keeps feeling not the way I want it to go. But that doesn't mean that we don't have plenty of examples of people, even during some of the toughest, most uncertain times. That's when wealth is preserved and wealth can really, really grow. Sounds counterintuitive. And I'm going to do another podcast episode talking about that, because I think a lot of people think, oh gosh, only when the stock market goes up do we all make money and does wealth increase. But it's not always the time when the most money can be made. And if you're interested in growing and preserving your wealth, I think these are all topics that are worth studying. Thanks for dropping by, y'all. If you found this podcast helpful, I would be so grateful if you would hit that share button and text it over to somebody. Share it with them. The podcast continues to grow, which we're so grateful, so grateful. And we're only able to do that with you and with your support. So have a wonderful day, and we look forward to seeing you on the next episode. All right, everyone.
Thank you for joining us on another episode of the Secrets to Abundant Living podcast. We hope you found inspiration and valuable insights that will empower you on your journey towards abundance. If you enjoyed today's episode, don't forget to subscribe, rate, and leave a review. Your feedback means the world to us, and it helps others discover the secrets to an abundant life too. Stay connected with us on LinkedIn, Amy Sylvis. Keep striving for your goals, nurturing your relationships, and embracing the adventure that is life. Until next time, we wish you an abundantly fulfilling day.